Ready to make your money work for you? Let's settle the age-old debate, real estate versus stocks. What is the smarter investment for your future? Both asset classes have their unique advantages and disadvantages, and they can play a crucial role in your financial portfolio. Let's break down the benefits, tax implications, and overall returns to help you decide which investment might be the best for you. First, let's set the stage. Stocks represent ownership in a company, while real estate involves investing in physical properties. Each has its own pros and cons, so understanding these can help you make more informed decisions on which way you decide to go. So, let's break down the advantages of stocks. First, liquidity. Stocks are generally more liquid than real estate. You can buy and sell shares pretty quickly, making it easier to access your money when needed. 2, lower entry costs. Investing in stocks often requires less capital up front compared to buying real estate. You can start with just a few $100s. 3, diversification. With stocks, you can easily diversify your portfolio across different sectors and industries, reducing risk because of the capital needed per stock you invest in. And 4, typically good returns. Historically, the stock market has provided great returns over time. For example, the S&P 500 has an average annual return of about 10 to 12% per year. Now, let's jump into the advantages of real estate. First, it's a tangible asset. Real estate is a physical asset, something that you can see, you can touch, you can walk through, which can provide a sense of security. 2, rental income and principal paydown. Properties can generate consistent cash flow through rental income if you purchase right, which is not available with stocks. Also, your tenant can pay your principal down every year, which can amount to a great sum of money depending on what your interest rate is. 3, tax benefits. Real estate investors can take advantage of various tax benefits, such as PRE, principal residence exemption. Selling your principal residence, you won't get taxed on the gains. CCA, capital cost allowance. Real estate investors can claim depreciation on rental properties. CCA also allows you to reduce your taxable income by writing off a portion of the building's value. And 3, deductible expenses for rental properties, such as property taxes, mortgage interest, repairs and maintenance, utilities, and the list goes on. What you can actually deduct from your expenses at year end. 4, appreciation on leveraged money. This is my personal favorite and the reason why I love real estate. While in stocks, you receive the gain on the total capital invested. In real estate, you receive your gain on the total value of the property. This means in stocks, if you have $100,000 invested, you'll make 12% return, meaning about $12,000 a year. In real estate, if you see a 6% growth in values, you'll buy a $500,000 piece of property with the same $100,000, but see a $30,000 gain on its total value, which can give you significant compounded gains over time. Now let's jump into capital gains comparison. What you want to know is when you exit on any stock or you exit on any piece of property, what is it that the government will ultimately take from you on your gain? When it comes to capital gains, consider this. If you invest $100,000 in stocks and earn a 12% return, that's a gain of $12,000. In real estate, you invest $100,000 to buy a $500,000 piece of property using $400,000 in leverage, you make about $30,000. Now, how does capital gains tax work in general? That $12,000 that you made on your stock portfolio would then be added to your personal income. So if you make $100,000 a year, now your taxable income would be at 50% of the $12,000. So now your taxable income will be at $106,000. With real estate, given the gain is obviously a little bit more, there's 2 options that you can kind of play out here. The first option is you refinance your equity, and everything that you make on the refinance is tax-free. That means that if your property goes up from $500,000 to $600,000, you can borrow 80% of the gain, which is huge. It's completely tax-free. The second option is you sell the property, and whatever that $30,000 gain was, 50% of it is taxable, meaning that $15,000 of it is added to your taxable income. Now at your end, you're going to be taxed on $115,000 in income. Now, the most important part of this video, let's compare the pros and cons of stocks and real estate. So, stocks, pros, easy to buy and sell, lower capital required, more options to diversify with less capital, and good historical returns. Cons, lack of control. You don't have control over what decisions a company makes in their day-to-day operation, which could affect stock price. 2, no leverage component. The money you invested is what you see a return on. 3, time-consuming research. If you don't have a financial advisor overlooking your portfolio, you're down to making sure you do the proper research on each company, looking at financial statements, industry trends, macroeconomic and microeconomic factors to determine if that's a good company to invest in for long-term growth. Now, real estate. The pros and the cons. The pros: tangible asset, generates rental income, various tax advantages, principal pay down, leverage, which is the most important thing, long-term appreciation potential, and the ability to refinance equity with no capital gains tax. The cons: higher entry costs. You typically cannot get into real estate with $1,000 or $2,000, depending on which area or community that you're buying into. Less liquid. They typically take longer to sell. You can't just go online and click sell and somebody will buy it. Depending on what the days on market are in that general area, you have to assess that and see how liquid that unit or that house could be. And 3, requires active management and maintenance. Yes, you can hire property management companies, but then again, it brings down your net on that property in terms of cash flows, but it does require active management. Condos require less management than houses do, but if you're buying into a house, they definitely require quite a bit of management. Now, in conclusion, both real estate and stocks have their distinct advantages and disadvantages. Stocks can offer higher liquidity and diversification, while real estate can provide stability, cash flow, and substantial tax benefits. Deciding between the two ultimately comes down to your personal financial goals, risk tolerance, and investment strategy. Many investors find success by incorporating both into their portfolios, which I highly recommend you do. If you found this video helpful, please like, subscribe, and share it with anyone who might be interested in learning more about investing. Thanks for watching, and I'll see you on the next one.